Hi, my name's Chris Ball and I'm the CEO of Hoxton Wealth, and today we're going to bring you a special on the tariff tantrums and what we've been seeing going on in the markets, which has been pretty crazy over the past couple of days. This video isn't designed to tell you which stocks to trade or what to do when. It's really to make sure that you're informed actually to what tariffs are, a bit of a history on tariffs, and then help you understand why it is not the time to be panicking and what makes a great and a good investor. This is for clients and also for people who are just generally interested in what's going on and how it can impact your financial planning. So, first off, I think a lot of people don't actually really understand what a tariff is. Essentially, a tariff is another way to describe a tax, and it's a tax that countries put on goods when they import them into a country. So why is Donald Trump bringing in tariffs now? I mean, there are many reasons, but the reason that they cite and the reason for them doing it now is because of the huge US trade deficit. So what is a trade deficit? A trade deficit is when a country buys more goods from outside and brings them in the country than they do when they export goods out of the country. So they're bringing more goods from other countries into their country. So, how much is the US trade deficit, and does it even make a difference? The trade deficit in the US is huge. It's $1.3 trillion annually, which is massive. But the US consumers spend an insane amount naturally. They just, are big spenders. They're an economy of people that spend big, same as we are in the UK and same as we are in Europe. So a history of tariffs. So let's have a look and go back and understand, kind of where tariffs have come from and how they've been used before. So the first set of tariffs that were brought in were the Smoot-Hawley tariffs in the 1930s. This was 20,000 tariffs posted on goods to protect American farmers. It was intended to combat the Great Depression. It went horribly wrong and worsened the global economic downturn quite a lot. The Reagan era tariffs, these are the ones from the 1980s. He imposed tariffs on Japanese electronics and cars to protect US industries. It's used in negotiations, especially when they're negotiating around trade imbalances, and it's often part of a diplomatic and economic strategy. Bush steel tariffs from 2002. These were temporary tariffs on steel imports to protect US steel producers. It faced strong backlash from trade partners and the World Trade Organization, and it ended early after economic and legal pressure. So how are the tariffs different this time? So what's different now? Tariffs today are more targeted and they aim to influence global trade behavior, not just protect domestic industries. Tariffs are used more as an economic weapon. And remember, we are in a, Donald Trump has effectively declared war one way or another on the rest of the world. There's a military war, there's an economic war, and then there's a cyber war. And we're currently very much in the midst of an economic war. That's what tariffs can be used for. The Reagan era, how it's different is Trump's recent tariffs are more confrontational and unilateral. He hasn't gone against one country. He's taken on absolutely everyone, which is quite interesting in itself and probably tells you a lot more about Donald Trump. He believes he can take on everyone all at once. And the modern tariffs are framed as America first policies, which protects against these legal downsides. And they're trying to bring in national security justifications and everything else like that, which we'll go on to talk about. So the three potential reasons for tariffs. Well, the first one that's been cited are national security issues. And if you think about it, it kind of makes sense. The US need more goods to be produced locally in the US in case they go to war. So if you think back to World War II, the US had a huge economic presence in terms of manufacturing. They were manufacturing lots of goods, planes, cars, all of this kind of good stuff. And when war hit, they were able to turn these manufacturing plants to produce tanks and weapons and things like this. They need to make sure that the important stuff that keeps the economy going round isn't coming from other countries, and they can be held ransom to that. During COVID, we obviously saw that. The US and many other countries couldn't get their hands on microchips that they needed. Microchips are extremely important now. As we know, we're making sure that an economy is running properly. This impacted essential things needed to run the US, and obviously that didn't put them in a good place. Their trading partners, or people that they have issues with, such as China and other countries across the world, are heavy manufacturers and they are producing goods. So this puts them a bit of a disadvantage, I suppose. This all sounds sensible for these essential things, but not for everything, obviously. It doesn't really matter. Let's take the avocado example that I've seen. It's not going to make any difference if you import your avocados or you make them there for national security in the US. So it does make sense. And actually, regardless of tariffs, all of this stuff is kind of happening. So it's unlikely that this can be used as the real compelling reason as to why tariffs. Now, this other one has been cited a lot by a lot of the administration, and it's bringing jobs back into the US. So if you think of the whole trade campaign, Make America Great Again, we need more jobs in the US. We need to make sure that we've got lots and lots of jobs in the US for the people that are unemployed. Why are we letting this get done overseas? Why are we letting them take our money? Why aren't we keeping it in the US? In reality, a lot of the goods manufactured overseas cannot be produced in the US. So again, we talk about the avocados. You can't all of a sudden decide one day as a farmer that you want to produce avocados instead of corn or wheat. I mean, that would take years to do. You also can't decide, if you're a manufacturer of clothes, to all of a sudden shift all of your manufacturing capabilities to the US overnight. It's just not going to happen. It's going to take time. So, and a lot of the jobs the US citizens will not want. So in reality, are they going to want to be farming avocados? Are they going to want to be putting Nike trainers together? If you think of how trade works internationally, trade is designed that you can do something well and actually we'll pay you more, or a good standard of wage that's low for our country but high for yours, so you benefit. And we will get goods at a cheaper price. That's generally how international trade does work and should work. If you think of Nike trainers, you're not going to have a queue of American citizens wanting to put together Nike trainers. Sheen goods. I was talking to our financial planners earlier, and I gave this example. My daughter bought 40 items for £54 on Sheen. You're not going to want to. No one in the US is going to take that salary cut to make those goods for that cost. Parts for cars. Again, they've been shipped overseas for years because it's cheaper. You've got higher skill for less to be able to manufacture these things and then import them in for a cheaper cost later. So in reality, it's going to make goods more expensive. The other thing is that we're talking about US, we need this huge amount of US jobs. We don't. Because the graph here illustrates, US unemployment is running at 4.2%. It's about 7 million Americans who are available to work. Okay, obviously some can't work for one reason or the other. 7 million people, 4.2%. And if you have a look at this graph, in reality, it's actually very, very low. The third reason, it's not fair how other countries put more tariffs on the US. So this was when he brought out this massive chart. I'm sure you guys have seen it in the news. He had what we get charged down one side and what we're going to charge others on the other. And he was going through bit by bit by bit. So, and this makes sense. It's not fair how they all have lots of tariffs on us, on the US, and we don't have tariffs or anywhere near as high tariffs on them, which, does kind of make sense. I mean, the way that the tariffs have calculated, there has been a lot of speculation exactly how they've been calculated and whether that's right or wrong. Again, we're impartial. We don't know one way or the other how exactly that's been done. But the argument is, let's put tariffs on everyone else to make it fair. And we give them a chance to stew it over, and then we will renegotiate the tariffs that they put on us and hopefully get them lower. So, how can we use tariffs to negotiate? And this all comes from Trump's art of the deal. So if you haven't read it, this is Donald Trump's book on how to negotiate the best deal. So, ask for the moon and land somewhere in between. What this basically means is I will ask for something completely outrageous or do something completely outrageous in the likelihood that we will end up in the middle. And if you look at it at the moment, that's pretty much what's going on. Countries apparently have already started to come to the negotiating table with Trump. People are already asking for meetings to discuss the tariffs and try and negotiate better tariffs for their country, which clearly would be playing into the hands of Donald Trump. But he has to be careful with doing it too quickly. And the reason being is that if he shows his cards too quickly to a couple of countries, it ruins it for all the other countries and it makes it look like that it was a big bluff. It could be the biggest bluff in the whole of economic history, and you wouldn't put it past him. He wants to give them a chance to stew it over, and then they will renegotiate is likely going to be the tactic. But we don't know, as no one knows. The problem is with this is the longer that it goes on, the more damaging the impact it could have. It won't go on forever though, as his administration is only in for 4 years. So even if this does end diabolically and he tries to keep hold of it, I'm pretty sure there's going to be a lot of pressure from a lot of places, but we know he's not the type of man to buckle with a bit of pressure. But, ultimately, in 4 years' time, he's gone. A new administration is who could well change it. So, it won't be here forever, I think, if it is a bad economic policy decision, which I think it's looking like it could well be at the moment. But we also know that he is erratic and he is irrational. And he has put things up and then completely U-turned on them a few days later when it doesn't suit him. Obviously trying to put a positive spin that America have won, and I'm sure he'll do the same. I'm sure he'll do the same then. But it's really interesting. Negotiating with people who are irrational is really, really difficult. It's tough. And this is what he's looking like at the moment. And maybe, again, this is a fantastic tactic to get what he wants. One thing he's not is a silly man. Markets like certainty. That's something we all know. We know that markets don't like it when things are not certain. So markets are freaking out because of Trump's shock and awe strategy. And it definitely is a shock and awe strategy. And the market so far is down 10% as of last week, and we're just waiting for the US to open. The UK has just opened as we're recording this, and it was 5% down on open. So when things feel uncertain, investors get nervous. And that can lead to slowdowns in the economy, causing a recession. And if you think of it in its simplest form, a private equity business about to purchase a goods business importing stuff into the US, is it going to go forward with its deal at the moment? No, it's not. Nike looking to build a factory overseas, are they going to go ahead with that investment at the moment? No, they're not. Car parts manufacturers, are they looking to go ahead with it? No, they are not. They're not going to be making big investments for things outside looking to go in the US, and they're also probably putting on hold big investments in the US too. But the markets that aren't acting like this is the end of the world at the moment. If they were, prices would have dropped way more. 30 to 40% is probably what we would have seen in those first couple of days. Now, the longer it goes on, the more likely it is that Trump actually is going to keep these tariffs up for a longer time. And clearly that's bad. So they've reacted in a way that suggests that there will be damage right now, but not forever. The good news is super cheap valuations for a lot of companies are presenting themselves, okay? Companies that we haven't seen these level of valuations since COVID. It's prime buying time. Now, what this graph illustrates is the S&P 500 since April 23. And what we can see in this is that actually we're still relatively high in comparison to where we've been over the past couple of years. But if we zoom out even further, which is important to do as long-term investors, which lots of us are, you'll notice that this is just a small blip so far. We're not anywhere near the bottom, although it feels pretty crap at the moment. We are not anywhere near where, we're not anywhere near 2008 or 2009 at the moment, okay? The longer it goes on, the worse it could potentially get. But this is the problem. No one knows what's going to happen. No one knows. No one can predict that he doesn't come out tomorrow and just say, do you know what? We're not going to impose the tariffs and here's what we're going to do as a result. This is the issue. No one knows. So the three possible outcomes. We'll deal with the worst case first. So the worst case is this is really happening, as in the tariffs are here to stay and we are in for a rough ride. The whole world will need to be restructured and everyone will start making things domestically instead of trading with international partners. That's really bad. That's not a good outcome, okay? Big recession in the midst if that happens. The second case, or the second scenario, is the best case. We go from worst to the best. And this is all just a negotiating tactic. He manages to reach quick settlements, he gets everyone round the table, and countries remove tariffs, and the US can sell more overseas. Okay, so the countries that they're negotiating with lower tariffs on US goods and US services. The US exports more of these goods and services overseas, encouraging more money to flow back into the US, and we kind of start seeing the market swing back around. US becomes a net winner and world trade speeds up. It's good. That's the best case. The in-between case, and I'm talking about markets on all of these, caveat this, I'm not talking about personally or morally, whatever the case may be. But the in-between case is that this all takes too long to negotiate, as he's done it en masse. And if you think this isn't kind of like a call calculated just Mexico and just Canada, this is a spray and pray. He's tackling the world, okay? He's gone to economic war with the world. And it creates disinvestment and uncertainty the longer it goes on, as we're starting to see. People don't spend, consumers lose confidence, corporate earnings get hit, and as we know, the main driver of the markets is future earnings, so what companies will earn in the future. It puts us into a mild recession. But as we know, after every bear market comes a bull market, and after every bull market comes a bear market. The importance of a diversified portfolio. So we've done a lot of talking about equity markets so far, but what's happened to the fixed income markets? Where are we? Well, what we can see is the Bloomberg aggregate bond index behind me, and we can actually see that's up. So we've seen a big dip straight down for the S&P 500. We've seen bond markets start to increase. And that's because in times of uncertainty, investors will flock more to these safe haven assets, bonds, and also potentially gold as well. We've seen a spike in that too. Should we sell everything and put it in cash? Should we just cash in everything and sit on the sidelines? 100% not. That is the worst thing you can do. And this graph, one of my favorites, illustrates taking the best days out of the market. So missing the best days, okay? And you can see that's the difference of a £4 return from $1 invested to a much, much higher return if you make sure that you're invested every single day, okay? Now, a lot of people will be saying, it's different this time, okay? We've not seen this before. And in the words of Sir John Templeton, the 4 most dangerous or most expensive words investors say, this time it's different, okay? Yes, it is different. We may or may not have seen this, but what we know is the markets are resilient and they adapt and they will come back around. So the first thing is do not panic sell. These are the top 10 largest gains in the S&P 500 daily gains, okay? And what you will notice is there's a common theme. They have all happened in times of heightened volatility. And if you're really interested, drop us an email and I'll send you this slide deck as well so you can have a look at it yourself. But on the right hand side, we've got a table of all these times. But you can see 2008, 2009, you can see the 1930s were the bottom two when we had the Great Depression. Times of real volatility, COVID, etc. in there. And what this shows you is that after the worst days, the best days happen. Volatility is part of investing, okay? It's not fun. But how many times from 1950 to now have we seen a drawdown of 10%? 26 times. How many times have we seen a drawdown, i.e. from the highest point to the lowest point, of 20%? We've seen it 11 times. And how many times have we seen a drop of 30%? We've seen it 6 times. Okay? And this just illustrates how common drawdowns are. The price of admission. I really like this saying. Higher volatility equals higher potential returns. A lot of people that are investors will have seen double digit, 10+%, maybe even 20+%, dependent upon their portfolio last year. You cannot expect to receive double digit returns and not to have volatility in your portfolio. Okay? When you invest in stocks, you're not just buying a piece of a company, you're also accepting the bumpy ride that goes along with equity ownerships. Market goes up and down, prices react to news, economic data, interest rates, and investor emotion. This is volatility, and it can feel uncomfortable at times, but here's the key truth. Markets go up and down, prices react to news, economic data, interest rates, and investor emotion. This is volatility, and it can feel uncomfortable at times, but here's the key truth. You get paid more for taking that risk. That is part of owning stocks. Volatility isn't the enemy, it's the price of admission. Stocks are riskier than cash, bonds, or savings accounts. That's why you get paid more. And by risk, we mean that they just go up and down more. It is highly, highly unlikely if you've invested in the S&P 500 for it to completely go to zero. Okay, it might be uncomfortable if you have to put in some of this, if you might have to draw down from this portfolio over the next little while, but ultimately it's not the end of the world, okay, over the longer run. And this is why we hold different asset classes. Cash is stable, but returns are low. Bonds are more predictable, but also have limited upside, and stocks fluctuate, but historically reward long-term investors with greater growth. And this is why we need different parts of our portfolio. So we have bonds and cash for short-term cash needs, typically shorter dated bonds to drive our cash needs over the next 2, 3, 5 years, depending upon what kind of investor you are or where you are and when you need the money. And then we have our long-term section of our portfolio, 5+ years or more, when we're actually going to need to access it, that's invested more into stocks. And this is why it's super important that you speak with your advisor to ensure that your portfolio is balanced correctly. And history shows it's going to pay off. Over the long run, the stock market has delivered an average return of 7 to 10% per annum over longer periods of time. It's much less in bonds and it's much less in cash. Now, the next graph that I've got on my screen is called the VIX, the Volatility Index. And basically, this shows you how the big spikes that have happened in volatility pretty much since 1950 to now. Okay, and what you can see is the VIX at the moment is over 42. Actually, this morning when I was checking it, it was over 53. So the volatility is getting higher. But the next chart, which is actually from Creative Planning, is a really interesting chart which shows you that after every year, 1, 2, 3, 4, 5 years, since we've had high levels of volatility, and you can go up and you can see the dates there when we experienced high volatility, what returns we've received then. So if you go right to the top, on the 24th of October 2008, the VIX was at 79 points, which is the highest it's ever been. The year following, we got a 20+% return, 2 years 41, 3 years 51, 4 years 79, and 5 years over 120% return. Yeah? So high levels of volatility are actually a leading indicator for good returns in the preceding periods. Next off, I always find it reassuring to me to try and listen to some of the great investors. At the moment, you've got all the people on the news spinning you yarns and trying to scare you and trying to get eyes on their screens and why you should listen to us. And if you watch the news, I'm not surprised you're scared. But don't forget, the news is not there to deliver you good returns. It's not there to make sure that you invest sensibly. The news is there to get your eyeballs glued on the screen to generate more media revenue. So Buffett, the stock market is a device for transferring money from the impatient to the patient. And that means people who sell down quickly, your money will be transferred to the people who are patient and in it for the longer run. Munger, if you're not willing to react with equanimity to a market price decline of 50%, 2 or 3 times a century, you're not fit to be a common shareholder. What he's basically saying there is if you can't handle volatility, get out of the market. You shouldn't be in the market, full stop. And it's very true. Peter Lynch, one of the most famous investors of our time, run one of the best mutual funds ever, said the real key to making money in stocks is to not get scared out of them. And now is the time that people will be getting scared. So, what type of investor do you want to be? Do you want to be a bad investor? Panic, sell when markets are down, and make extremely irrational decisions? Do you want to be a good investor who does nothing, waits it out, and knows they're in it for the longer run? Or do you want to be a great investor, lean into volatility, and look to deploy more into the markets during the times of higher volatility when you can get really good valuations? Okay, last time, like I said, we saw prices this good was during COVID for some of the assets that are available. And I quite like this nice little picture to the side. So what are we doing about it? Actually, overall in our portfolios, we aren't doing a huge amount. Okay, but in our actively managed strategy, which is in the Hoxton Wealth Funds, which we put together with Adderton, we have the moderate and adventurous, we've taken this. So over the past 3 weeks, we've been taking a more cautious stance on global equities. And a key part of this has been reducing our allocation to US equities, as we believe that the recent tariffs could hit the US market harder than other regions. It's a defensive move, not a reactionary one. It's just a reflection of the current macro environment. To balance this, we've lent into gold a little bit as a hedge, and we're now holding around 9 to 9.5% of physical gold within the fund. We see it's a strong diversifier against market volatility and geopolitical risk. And on the fixed income side, we're also slightly underweight overall compared to the benchmark, with exposure to US Treasuries. We're positioned to benefit if bond prices rise, if yields fall, or if markets continue to seek safety. The key message is we're not sitting on our hands, we're not doing anything. Actually, in the portfolios that are run with our investment partner Adderton, we're making key strategic changes to ensure that we're protected on the downside. So it's very, very difficult for every planner at the moment to get out and speak to every single client. That's ultimately not going to happen. But having the allocation into these funds is exactly the reason why we do it, because we can be very tactical quickly within it. So we are making changes and we're making sure that these are implemented. If you've got any changes, if you've got any points or anything that you want to discuss, please get in touch with us, chris@hoxtonwealth.com, and I'll make sure one of the advisors get in touch and assist you. Okay? I hope you found that useful. I hope you found it insightful. Do you want to be a bad investor? Do you want to be a good investor? Or do you want to be a great investor? That's your choice. I'll leave it up to you. Any questions or queries, as always, chris@hoxtonwealth.com. Please let me know. I hope you found it informative, and that provides you a bit more information on what's currently going on. We'll keep you updated as always, and thanks very much for tuning in.